Welcome back to Trade with Conviction, your fast track to understanding the oil market. I'm Neil Crosby, and I am back again with execs still doing some things of very high importance relative to this, although the podcast is very important. I have June and Hua with me today. Hi guys, how are you?
Hello. Very good. How are you doing?
Oh, very good. You guys have a Christmas party tomorrow. What are you doing?
We're going to a yacht.
You're getting on a yacht?
Office. Yeah, a family event.
We're doing a little cruise around the Singapore waters, try to look out for the dodgy ships that are passing through waters.
Oh, that sounds pretty good. That beats what me and Phil did in Vienna. We went out for a beer and a burger. That's low key, relatively speaking. Right, why don't we get stuck in? So we'll do, I thought we could do kind of first look at some questions that we might be able to answer for 2026. I mean, let's do the headlines first, but I want to spend half the pod just thinking about some questions for next year, particularly in light of the fact that the market seems pretty calm. Probably half the market is not really trading or thinking about packing up for Christmas, so it seems like a good time. But June, do you want to start this off? I believe there was a tanker seizure last night. What's the deal there?
There was a report that the VLCC called the Skipper was seized by U.S. forces off Venezuela. It was carrying 2 million barrels of Mare crude, which is a very heavy sour crude from Venezuela, and it's likely destined for China. This vessel was actually sanctioned back in 2022 for illicit oil shipments relating to Iran under its former name, Adisa. And the seizure of this vessel marks the largest escalation of tensions between the U.S. and Vance. Within Sparta ourselves, we've already been talking about what will happen if there is an escalation of the Venezuela conflict, and if there's a loss of oil supply. I think the impact is actually quite low because, number one, the roughly 1 million barrels per day of flow from Vance is primarily exported to China, and the teapots there are able to find alternatives like high sulfur straight run residue as a feedstock for their bitumen production. And the US is only 100 kbd of flow. So we already have quite a big supply of Gulf of Mexico crude as well. So yeah, I think the headlines really didn't really move oil price that much as well.
If you think about it, even if there is, the actual fighting between the US and Venezuela, I think it's probably going to be a little bit far away from where they are actually producing the crude in Venezuela. So like the actual disruption is probably going to be minimal. I think more disruption is probably going to come from the fact that they need either Russian naphtha or Iranian conde as diluent for the production of their crude, to try to get the crude out. So, and that might obviously be disrupted if there is fighting. So.
Yeah, but again, it's all these things, maybe a bigger impact on naphtha, but flat prices, unsurprisingly, fairly dead to this kind of news at the moment because of the size of the supposed problem that we have on the balance. So it feels like oil is able to fade almost anything right now. And speaking of fading risk, let's say, it does feel like increasingly from day to day, week to week. Is there any risk being priced in the market that US sanctions are really going to bite in terms of Russian oil? So my impression is just kind of leaking out day by day, various additional Indian refiners are thinking about taking more Russian because the discounts are strong. Is that a fair thing to say? I guess I pose this to both of you.
I think it's a fair statement indeed. We've already been discounting the impact of the US sanctions when it first broke out for the Lukoil and Rosneft one. It's about the entities being sanctioned and not the oil. So there will be new intermediaries to come up to still find oil flow for that, and we are definitely seeing that happening right now for the Russian barrels.
Yeah, so kind of rinse and repeat as usual. Okay, so why don't we do some 2026 questions? We can do a few today, maybe a few next week. We can kind of rattle through them. The first one, I was thinking, and you guys maybe have opinions about this, but why hasn't the oil glut shown up yet? So we've got maybe some movement in US stocks and kind of building above seasonally normal, but it's not huge. The question I guess becomes oil and water, does it count? Some of it is seemingly because there's more long haul crude. Some of it is due to sort of sanctions risk and crude building up on water. There's probably some Iranian stuff floating offshore in China. There's probably more exports out of Saudi Arabia. Does it count what, or are we likely basically to see it emerge on land at some point in the next quarter? Is that probably a fair statement?
So I think the oil on water number has been, a big 1 billion barrels or something. But in actual fact, there's always that baseline flow on water anyway. So maybe we're talking about 300 million barrels of extra oil due to all the things that you mentioned earlier. It should somehow come to land, whether it will all come in Q1 or, within January itself. I think that's probably the debate here. Some of this will still be on water due to like port congestion and the likelihood of, taking a bit longer to clear whether the oil is compliant to sanctions or not. But I think the consensus is it will appear on land within the next few months. If it doesn't, then we are back to a 2025 story where we all thought there was an oil glut, but it didn't happen.
There's just two other things to point out. One is that there has been a build in US NGLs. It's quite substantial this year. So the question, as we've said before, of whether that really counts as well. So perhaps some of this should be going into NGLs or thinking about that next year. The other thing I just want to point out, we should all still be watching the US adjustment factor, which has moved from basically positive 600,000 barrels per day in early October, which means that the stock build is too high versus the balance in the weeklies. And that's moved to minus 200,000 barrels per day. Recently says an 800,000 barrel per day swing. So something is up in some of the aspects of US data. Either it's the implied supply or the actual supply. Either it's the exports, either it's the stocks data itself, could be the imports. So something is up and changed in the US data itself. Just to point that one out. Let's just move on. So let's talk about China, because I felt like that was an important point that you were bringing up, June, with regards to oil and water. So there is a kind of black swan scenario I'm thinking about where Chinese stock build really accelerates next year. Maybe it doubles. Maybe there's geopolitical considerations at play, trying to partner, support their partner in Russia, for example. But what do we think is the outlook, generally speaking, for Chinese crude imports next year?
I don't think we have a real crystal ball to say what is the number.
Yeah.
But directionally, let's think about the factors that will affect the imports. Number one is the internal demand. It does seem like it's declining. We do hear the gasoline fleet is reducing. EVs are taking over. Even diesel trucks are also being replaced by EV. So overall demand for transport fuels are coming off. We've seen product export quotas in general still very much aligned to just balancing domestic requirements and not wanting to flood the export markets. So the crude run rates, therefore, internally will likely be either status quo or slightly lower, except for probably the only upside is the new refinery that's coming online next year, called Hubco, which is a 300 KBD kit. But in terms of what else they could do, they can, number one, they can bring in more Russian crude to balance off the whatever that is backed out by China. In terms of SPR, they also can increase more, especially if you're talking about flat price being very low and in the oil glut scenario. I think they would really want to increase their buying at a higher rate to capture the opportunity. We already saw that this year. For 2024 versus 2025, flat price has come off like $11 per barrel on average. And we've seen, therefore, a lot more reports of like 1.1 to 1.5 million barrels per day of stock build. Can that double? It's possible. They probably have the logistics to do that. So I believe it's a flat price story as well here, where China's buying will be the floor. Because there's more term barrels that China will be likely to buy, given the favorable official selling price and the incremental sanction crudes that they might be able to take, we expect spot buying activity from China to also reduce. So in terms of how Dubai market will be, that could be a very interesting scenario for 2026.
Very good. It's one of these things where we don't really know what the real length will be next year. So one of the questions we had on mind is, what do OPEC do? I think we can agree that they know that there's a problem. You can see that from the fact that they've paused hikes, from their very low OSP. And so when you have a big problem like this, let's say we're 4 million barrels a day long, you have to start thinking about a big change in price and what that does to all the mechanics, right? One of which is Chinese buying. one of which is things like demand. So demand growth is pretty poor this year, probably all told. They're probably under 1 million barrels per day. What happens if that kind of doubles? Let's say there's a sort of resilience to tariffs story, which is emerging certainly over the last couple of weeks. I've seen more headlines about US motorists getting back on the road in record numbers because gas prices are below $3 a gallon. And all these things do have an effect. And then you add in some things into the mix. OPEC begin a small cut. Something happens in Libya. And you actually turn this picture around quite substantially. So it's just, obviously we're talking about crystal ball stuff. But when you do have a big change in price, let's say the flat price drops to 40, 50, you start getting questions about US shale again, you start thinking about demand, and things actually start to look different within, 3 to 6 months even, when the narrative starts to change. So it's just important that we kind of think about all these aspects at this point in time, what to watch out for. Okay, one last question before we move on, just conscious of time. Margins, can they deflate next year? Also bearing in mind what I've just talked about in terms of what happens if demand actually surprises us to the upside. What does that mean for margins?
First of all, I think we look at the refinery capacities here in the world. Globally, there seems to be a bottleneck, right? Because 2025 has seen very tight refining capacity issues already, and therefore the margins were inflated. Are we going to see the same in 2026? The online capacity next year, there are very few that we note. We know that 300 KBD of HUBCO in China. There's 180 KBD of India's HPCL Barmer refinery that was supposed to start up in Q3 this year, but now delayed to 2026. And a small refinery expansion in IOC Gujarat, about 86 KBD.
There's a bunch of oil and water, but it's not to do with the demand collapse, which I find very funny because it's got nothing to do with demand, right? It's about how much supply there is to the market. And if we say there's a bottleneck in refining, then the problem is even kind of doubled because you have this glut of crude building up and you have nowhere to refine it regardless of the margin. So that's a funny one that I keep on picking up from kind of social media over the last couple of weeks. All right, let's do some physical market stuff. I know that was quite lengthy. We can start off, looking at the time, we can start off with crude. Shall we lean on you again, June? You've been talking an awful lot, but I was sort of writing up some things last night, and it did appear to me that there might be a few kind of bearish things mounting up for Dubai, and I note that apart from the very prompt Dubai spreads are actually in contango this morning, and the EFS has jumped to kind of 50 cents. So what do we think about the Dubai outlook just for the very immediate future?
We start with a refinery situation. So Alzo was the big one. It was supposed to restart on the 9th of December. There is rumors that it's now delayed to end December, and that should be bearish heavy sour crudes. For CPC, the attacks last week, SPM maintenance is now slightly delayed in terms of restart to mid-December. That's another bearish situation. And the Iraqi West Qurna production is back up, which is the Basra streams, and that's again another bearish picture. Flat price actually, has the only thing that's moved, and as you rightly pointed out, time spread for Dubai is actually in contango. For the physical market, it's not really active yet this week. It's going to start next week when we have the Qatar Energy tender on the 16th of December. It's going to be a very frantic, compressed physical trading window this month because usually around Christmas, all the traders will be packing up as well. So we've got essentially 1 week of very frantic trading coming up. Other factors for Dubai that we note, the OECD maintenance is around the corner. The Arab Light OSP was very cheap, the 5-year lows. Additionally, we have the Indian sanction risks being faded, as we talked about earlier as well, with more refineries going back to buying Russian. And who knows, maybe Alzo restarts more in Jan rather than DEC.
Yeah, looks like there could be a bigger problem there. So all seems like it might be mounting up a bit for Dubai. Okay, let's move to you, Hua. You've been characteristically silent so far, I would say, or uncharacteristically. Now, I would just say characteristically. Why do we do fuel oil? What do you see on fuel oil just now?
Sure, yeah. I mean, to be honest, both low and high sulfur are pretty much pretty boring at the moment. We've got physical and spread both in contango. I think low sulfur is slightly better. It's roughly flat at the moment. So slightly more constructive. you've got the whole system kind of screaming for more low sulfur straight run, and even like the heavy sweet crudes to go into more complex kits, either your low sulfur straight run go into your FCC, etc., or certain heavy sweet crudes go into proper, refineries. And in recent weeks, we saw diesel collapse, but obviously Asian RFCC margins, the proxy that we produce every week, that is sort of preserved at historically very high levels. And the reason for that is because VLSFO has also collapsed accordingly at the same time as diesel, which is, to me, is fairly interesting, because in the past you have instances of, where either diesel or gasoline collapse, but VLSFO barely budged, was pretty much still there. But now both are collapsing at the same time, so your RFCC margins are preserved at very high levels. So it's kind of like the whole system is screaming for more low sulfur to try to clear into the feedstock pool, which is exactly what we've been trying to say. The problem in the VLSFO market is the fact that there is just way too much of the low sulfur straight run and not enough of the secondary processing capacity to match that. So yeah. What else is interesting? Dangote turnaround. I think we talked about it briefly. Pushed back to 15 December. That's the RFCC, by the way, not the CDU is still running. It's just that the RFCC is going to be on turnaround on the 15th. Duration is shortened somewhat. I don't know. There's also this rumor that's going around that they're going to tender out more, the grade 8 and grade B RCO from Dangote. So it's going to be 3 cargoes in total for a month, which is decent amount, just a rumor flying around yesterday. PRF Chem or Rapid or Pengerang, that's coming back online right now, seems to be the case. We looked at the tenders. They've got a tender for gasoline and propylene, no tender for atmospheric residue. So I think the FCC is probably, back and running. If you look at simple margins on certain heavy sweet crude, for example, dark blend in Southeast Asia, and that's obviously the equivalent of, somebody like Vito taking the DAR through their Tanjung bin simple kits, and then just put the residue, or we call it the flash DAR, into 0.5 blending, etc. So that has been compressed a little bit, but FOB dips for DAR is also low at the moment. So I think even though margins on the simple kits are compressed, I would say they're not punishing enough, to get these guys to reduce their runs to the simple kits. And, so I think there's an argument that Sync 0.5 crack will have to do a little bit more work to the downside for that to happen. So, but is there going to be a floor here? How bad do you think things can get? The floor for dark blend that we just talked about just, a second ago is going to be what is cheap enough for the more complex refineries in North Asia to take. We did this chart last week where we compared the difference between putting dark blend through a simple kit in, Southeast Asia, the Tanjung bin example, versus sending that to North Asia, putting that through a more complex kit, in this case, either medium or complex. And the difference between the medium versus the simple in Southeast Asia is like $5 right now, it is a big difference. So, to me, that's worth the trouble of taking the stuff to North Asia and trying to, put down to refineries, like proper refineries. Whereas it's interesting, 0.5, I think we had this trade idea from last week that turned out to be pretty decent. So the whole trade idea was, going long east-west, 0.5 east-west, and going short TD20 at the same time. But, of course, our argument wasn't so much, based on the fundamentals for East-West, as a standalone trade, but more like the gap between East-West and also the physical freight and cost of shipping the stuff from Rotterdam to Singapore. So that turned out pretty well, and the gap is now a lot smaller. And talking about East-West, I think the Rotterdam-Singapore 0.5 apps is also a little bit less workable right now. So, probably there's still a bit of room for East-West to move up few more points, but it's kind of like, not really much left there. So to be honest, not really any compelling reason to be bullish low sulfur at the moment, but overall I think still slightly more constructive than high sulfur, which is why we still think that Sync High 5 is a little bit undervalued.
Okay, so I'll just run us a bit through gasoline and then we can resume normal service as of next week. So there's just a couple of things to talk about. The one is that the US is starting to show, basically the first out of all regions, sort of standard winter dynamics. So looking at the data yesterday, we've got gasoline stock builds that at the very least look normal, if not slightly above normal for this time of year. So we're building quite rapidly. We've got 2 cents per gallon prompt contango. We've got the Gulf Coast still pricing to push out barrels over ARA in many places, at least in the Atlantic Basin. And the one interesting thing about that is the kind of juxtaposition with Pad 1. So Pad 1 remains relatively tight on stock, but the thing is, looking at the TAR, the RBOB bar, we're still not really signaling anything in terms of moving the standard TA barrels from Europe in terms of gasoline. So it usually really should mean just now that we should be allowed to build stock in ARA, assuming also that various refineries come back online, things like Pernis, which should be back up and running now, if not very soon. The other interesting thing is in WAF. So inventories in WAF are reportedly quite high, and we don't really see any sign in terms of pricing or in fixtures of a bigger drive to push flows increasingly to WAF on top of what we already see. So it doesn't seem like Dangote maintenance is making a huge impact there yet. So it's all quite calm in terms of EBOBs, and I think this is all kind of allowing EBOB spreads to drift lower. And the last one's in the east, so that's still dominated really by a handful of unit outages. A major one recently, and that's been impacting the regrade as well, has been the Japanese refining complex, which had its issues. And outside of this, really things are kind of looking normal again. There's been one RFCC outage at Ulsan, but it seems like the big spate of outages in Asia that was keeping gasoline supported is now easing off. So it seems like we're allowing ourselves a bit more of a kind of standard winter pattern globally, let's say for the next month or two. All right. That's a wrap from us here at Sparta. As ever, if you want to write us and let us know any different opinions, feel free to shoot us a message. And aside from that, I don't think I'm too early in starting to wish everybody a bit of a happy start to their holidays if they're already going on holiday or vacation. And of course, it's started to feel a bit festive already. So I hope everybody's ready for a nice break. And we'll pick up again, I think, one more week of podcasting next week, and then we'll sort of resume our service of scrutinizing the market from January. Thanks very much, guys, and until next time.